Welcome back to Investing Talk Podcast. So our mission today, it's pretty focused. We're looking closely at POET technologies. And we're tackling that big question lots of people are asking, is now a good time to buy? I mean, this company, it seems, positioned right in the middle of all the AI and data center excitement, the infrastructure side.
Absolutely.
But then you look at the financials, and, well, they tell a really challenging story. It looks like a major transition period.
You're putting it mildly, yeah.
So we're going to analyze everything we can get our hands on. The tech, which sounds unique, their financial runway, those high-stakes rumors swirling around.
Right.
See what's driving this crazy volatility.
Right.
And hey, if you find this kind of analysis helpful, please do hit that like button, subscribe, maybe drop us a comment below.
Yeah, definitely let us know.
And if there's another company you want us to look into next time, just put it in the comments. Okay, let's get straight into the technology.
Okay, so to really get the bullish case here, you have to start with what POET actually does. I mean, the whole story, the reason analysts are so positive, it all hinges on their core tech, the optical interposer platform. That's the pivotal point.
Okay, optical interposer. Let's unpack that a bit. We hear optical electronic devices all the time. Can you maybe give us an analogy? Like, why is this specific thing potentially a game changer?
Sure. Think about it like this. Inside a normal chip, data moves around on tiny copper wires.
Right.
While that's relatively slow, it generates heat, uses quite a bit of power. POET's tech basically creates this super fast highway inside the chip package itself, but it uses light, not electricity, to carry the data.
Okay, light instead of electrons.
Exactly. And their interposer platform lets them integrate the photonic bits, the light parts, directly with the electronic components on the wafer level.
Wafer level, so that's super early in the manufacturing process.
Yeah, very integrated. And doing it this way, it gets rid of major bottlenecks, cuts down heat, and critically, it promises to drastically lower manufacturing costs and power consumption. It's genuinely described as unique in the public photonics space. That's really their competitive moat, their secret sauce.
That definitely clarifies the potential advantage. And it looks like the industry is starting to take notice, which is, well, essential if you want to sell to those huge hyperscale buyers, isn't it?
Oh, absolutely. Validation is key. And we've seen some major recognition just in the last, 3 months or so?
Yeah, like what?
Well, back in August 2025, POET actually picked up a pretty significant industry award. The most innovative chip-scale packaging optical subassembly product at the ECOC 2025 Awards.
ECC. Right, that's the big European conference on optical communication. That's not a small deal in that world.
No, it's a huge event, a big vote of confidence. And their main product line, the PO8 Teralight, these are 1.6 terabit optical engines that got a lot of attention there.
1.6T, okay.
Then, fast forward to September, they were doing live demos over at CIOE, that's the China International Optoelectronic Expo.
Another big one.
Yeah, and they were specifically showing how this tech fits into the architectures needed for, scaling up AI networks and for those massive hyperscale data centers.
Okay, so if we connect the dots here, this isn't just about getting some nice plaques for the office wall.
Yeah, no.
This industry recognition, it's like a signal flare, right? It tells those really picky buyers, the Googles, the Microsofts, that POE might actually have the goods, that they're moving past just R&D.
Precisely. It strengthens their credibility massively. They're showing they have the technical chops and are serious about commercializing this, about scaling it up.
But, and this is the big but, isn't it? That technical success slams us right into the financial reality check.
Yeah.
If the tech is so great in getting awards, why do the recent financial results look so, well, grim?
Yeah.
That contrast is the core issue for investors right now, I think.
Yeah, it's a stark contrast. If you just look backward, fiscal year 2024, reported revenue was only $41,427.
Wait, hang on. $41,000. Not million.
Thousand.
Wow.
Yeah.
Okay.
That's
less than the price of a decent car. If revenue's that low, how come we haven't seen, like, a total collapse in confidence? Or a management change? That sounds brutal.
It does on the surface, but that's the essential context you need. That tiny revenue number, it represents a drop of over 91% compared to the year before.
91% drop, okay.
And the net loss got bigger too, $56.7 million. But here's the key. That performance reflects a strategic choice they made. They basically pivoted away from older, maybe some revenue-generating products to pour every single resource into this new optical interposer platform.
Okay. So the loss isn't just bad sales, it's deliberate investment.
Exactly. It's R&D spending. They're generating negative gross margins, negative operating margins, because the money's going into developing the tech, trying to secure those initial design wins with big customers and building up the capability to actually make this stuff in volume later on. It's not about servicing current sales.
So it's almost all R&D expense right now, measured against almost no current revenue.
Yeah.
Okay.
Right.
Yet, you look at the analysts, I think there are two covering the stock.
Yeah.
And the consensus rating is a strong buy.
That's right.
How do you possibly square a strong buy recommendation with, $41,000 in annual revenue? That seems like a disconnect.
Well, the analysts aren't really valuing POT based on what they sold last year. They're valuing the pipeline, the potential, the intellectual property, that competitive moat we talked about.
Okay.
They're betting on a really rapid, really dramatic turnaround in revenue and margins.
Yeah.
The whole thesis is that once customers actually start adopting this, once those design wins move from just samples and testing into actual volume production.
If they do.
If they do, yes. Then the top line could just explode upwards. They think it could justify a valuation potentially in the billions down the road. They're pricing in the future disruption, not the current financial snapshot.
Okay, that makes sense conceptually. But to get to that future, they need to survive now. They need cash. So let's look at their financial health.
Good point.
The balance sheet, thankfully, looks pretty flexible. They have almost no debt, which is a huge plus for a company basically still in the R&D phase.
Yeah, de minimis debt. That definitely relieves some pressure. And as of the end of Q2 2025, they reported having $16.1 million in cash and cash equivalent.
$16.1 million, okay. So given the burn rate from all that R&D, what kind of runway does that give them?
Well, doing the basic math, even with that negative free cash flow, that cash position probably gives them a runway of, let's say, at least 3, maybe 4 quarters at the current spending rate.
3 to 4 quarters. That feels pretty tight, doesn't it?
It is tight. Very tight.
So what specifically do they absolutely have to show, say, in the upcoming Q3 results or by year end to make that runway feel a bit less precarious? What stops that immediate dilution threat?
Right. They desperately need to show tangible progress. Proof of concept validation is good, awards are good, but what investors really want to see now is evidence of customer commitment.
Like money changing hands.
Exactly. Converting those samples they've sent out into actual non-recurring engineering, or NRE fees, or even small initial pilot production orders. Something that says, okay, this customer is serious.
Right.
Because every week, every month, they delay getting into real production, it just burns through that cash faster. They have to demonstrate the market is genuinely planning to adopt this, not just kicking the tires indefinitely.
Okay. That sets the stage perfectly for the next part, which is probably the most exciting and definitely the most volatile aspect of this whole story. If the current financials are so weak, what on earth is keeping the stock price relatively high and driving these huge daily swings? We need to talk about the potential catalysts.
Yeah, we're heading into a very, very high-stakes period for them. Coming up really soon, October 15th, is their Q3 2025 earnings release.
Crucial date.
Absolutely vital. Investors are going to be demanding clarity. Did those awards, those demos at ECOC and CIOE, did they translate into any financial traction, any revenue, any firm orders, anything?
Yeah. Show me the money, basically.
Pretty much. And then beyond the company's own results, you've got just pure market mechanics that could drive volatility.
Like what?
Well, coming up in November and December, you often get institutional portfolio adjustments, ETF rebalancing. There's talk of a major global ETF rebalancing, plus the usual institutional investor holdings disclosures.
Okay. So fund managers buying or selling for reasons completely unrelated to POE's actual business could move the stock.
Exactly. These kinds of events can trigger big moves up or down that aren't really based on fundamentals, just flow-driven.
Okay. Now, let's get to the juicy part, the rumors, because that seems to be where a lot of the perceived option value is coming from, right?
Yeah, definitely. This is where the speculation gets really intense. There are a few big ones swirling around.
Okay, lay them on us. Rumor one.
Rumor one, and this one could be absolutely transformative if true, a potential Tier 1 U.S. cloud provider partnership.
Tier 1. So we're talking the biggest names.
Yes. Unconfirmed reports, whispers really, suggest they might be in late-stage talks with a major U.S.-based cloud giant. Think maybe Google, maybe Microsoft, for using their tech in hyperscale data centers.
Wow. Okay, if that actually turned into a signed contract.
Game over, potentially. I mean, it wouldn't just accelerate growth dramatically. It would be the ultimate validation. The biggest players in the world saying, yes, this interposer tech is the future. That's the dream scenario.
Huge. Okay, what's rumor number 2?
Then you've got this sort of persistent industry chatter about a strategic acquisition or investment.
Someone buying them or investing heavily.
Yeah. The talk points towards interest from a big established semiconductor company, someone looking to quickly bolt on advanced photonic integration capabilities without spending years and millions on their own R&D.
That makes sense. Buy versus build.
Exactly. It's often faster and cheaper for a giant company to acquire the tech. That's kind of the ultimate exit strategy for early investors, right?
And rumor 3.
Rumor 3. Reports of a breakthrough AI cluster design win. This is more specific. The chatter suggests POET might have actually secured a design win for their Teralite engine.
The 1.6T one.
Yeah, for use in a next-generation AI computing cluster, one that's apparently set to start ramping up production in early 2026.
So that would lock them into the next wave of AI hardware spending.
Precisely. Another massive potential win if it's real.
Okay, so you've got these 3 potentially huge but totally unconfirmed rumors floating around. What does this accumulation of speculation mean for someone thinking about investing right now?
It means the stock is trading largely on hope and future potential, not on current reality.
Right.
If even one of these major rumors actually happens, gets confirmed with a press release, then the current analyst revenue estimates, which are probably pretty conservative right now, could get revised upwards incredibly sharply. Okay.
So investors are essentially paying for an option. They're buying the chance that one of these big catalysts hits in the next, say, 6 months or so. High risk, high potential reward.
Which naturally brings us to the flip side. You can't have that kind of potential reward without significant risk. Let's lay out the necessary counterpoints. What could go wrong here?
Oh, plenty.
Yeah.
The number one company-specific risk is simply execution risk.
Meaning
they fail to convert those potential design wins, those customer samples, into actual, reliable volume production orders. Getting qualified by a hyperscaler is notoriously difficult. It takes a long time. The standards are incredibly high. If POET stumbles on the manufacturing scale-up, if they can't deliver reliably,
then the revenue ramp gets pushed out.
Exactly. Delayed. And possibly delayed past that crucial 3-4 quarter cash runway we talked about.
And if that happens, that leads directly to risk number 2, dilution risk. Yep. If the cash keeps flowing out because the big revenue isn't coming in yet, they'll almost certainly have to raise more money. And the easiest way is usually issuing more shares.
Which waters down the value for existing shareholders.
Significantly. And then just broadly, there's market risk. The stock is clearly high beta, highly volatile. The average daily price swing is around 3.9%.
Wow, nearly 4% a day on average.
Yeah. So this is definitely not a stock you buy and just forget about. Any piece of news or even just market sentiment shifts can cause really large moves, both up and down.
Okay, risks acknowledged. Execution, dilution, market volatility.
Got it. Now, despite all that risk, what does the technical picture look like right now? Where's the stock actually trading?
Well, despite the risks, the technicals actually look pretty constructive, surprisingly so. As of today, October 2nd, the stock's trading around $6.28.
Okay.
And critically, it's trading above both its 50-day moving average, which is currently around $5.47, and its 200-day moving average, sitting down at $4.85. Okay, so being above those key long-term averages, that generally confirms the underlying trend is still bullish, right?
Yeah.
Despite recent bumps.
Correct. It suggests the longer-term uptrend is intact. But what about the very short-term momentum, given the volatility? If we look at something like the 14-day relative strength index, the RSI, it's currently reading about 30.11 hin. Now, technically, an RSI down near 30 often suggests a stock might be oversold in the immediate short term.
Oversold, meaning it's fallen too fast, too quickly, and might be due for a bounce.
That's the typical interpretation, yeah. Especially when the longer-term trend is still positive, it hints that the recent selling might be exhausted short-term.
So what are the technical analysts projecting based on this setup? Any targets?
The projections based purely on technical analysis are actually quite aggressive. They're pointing towards a potential bullish target range of somewhere between, say, $7.29 on the low end, up to maybe $11.59 on the high end over the next 3 months or so.
Wow, $11.59. That's a huge jump from $6.28. But hang on. If the average daily swing is almost 4%, doesn't oversold just mean it's primed for another massive swing in either direction?
It's a very fair point.
I mean, hitting $11 surely depends entirely on one of those rumors becoming reality, doesn't it? The technicals alone can't guarantee that.
You're absolutely right to inject that caution. The technical structure trading above moving averages, RSI being low, it supports the potential for a rally if the fundamental story delivers, if the positive news flow continues or accelerates.
Okay.
The technicals are basically confirming the underlying bullish bias that the speculative fundamentals are creating. They aren't generating the target in a vacuum. That $7.29 to $11.59 range is heavily reliant on one of those big catalysts actually hitting.
Got it. So summarizing the overall sentiment picture then.
Well, you've got retail investors looking at places like StockTwits or Reddit, generally very optimistic, very focused on the potential. And institutional holdings, while not huge yet, have shown steady, if pretty modest, accumulation. So the market seems positioned for growth, but it's definitely aware of the high wire act involved.
Okay, so bringing it all together.
Yeah.
Based on everything, the unique tech, the analyst conviction, despite the financials, the intense strategic activity, and rumors. What's our overall assessment?
I think the takeaway is pretty clear. The technology moat seems real and defensible. The industry validation is definitely picking up steam. And the potential strategic catalysts are, frankly, massive if they land.
Right.
So the risk-reward profile, right now, it does seem tilted towards the bullish side, mainly because the perceived value of that future pipeline just dwarfs the current lack of income.
So on our scale, where would you rate it?
Based on all that, I'd give it an 8.5 out of 10 bullish rating overall. The company really does feel like it's right at an inflection point.
An 8.5.
Yep.
Okay, pretty strong bullish conviction there. Who is this type of investment actually suitable for then, given the risks and volatility?
Yeah, it's definitely not for everyone. I see it as attractive mainly for two specific types of investors.
Okay.
First, you've got your aggressive short-term traders, people looking to play specific events, maybe trade around the Q3 earnings release or react instantly to any partnership news.
Event-driven traders.
Exactly. And second, you have the patient long-term investors, people who genuinely believe in the technology's disruptive potential and want that structural exposure to the growth foundations of AI and hyperscale computing. But, crucially, they must have the stomach for extreme volatility along the way.
Patience and a strong stomach required.
Absolutely. So maybe the final thought, the really provocative question for listeners to consider, boils down to timing.
Yeah.
Given that tight cash runway and the aggressive potential timeline,
Yeah.
which piece of crucial information is going to hit the market first? Will it be the stunning confirmation of a major Tier 1 cloud build that instantly validates everything? Or will it be the Q3 earnings report showing hard evidence, actual numbers, that prove they're successfully converting those customer samples into real, tangible orders and revenue right now? Because the answer to that question, which comes first, is what will truly define shareholder value heading into 2026. That's what will decide if that, say, $11.59 technical target is wildly conservative or just completely unattainable.
That perfectly frames the high-stakes gamble investors are taking here. Excellent points. Thanks for breaking all that down.
My pleasure.
And thank you all for joining us for this analysis. Don't forget to like, subscribe, and definitely let us know in the comments what company you think we should put under the microscope next time. We'll catch you on the next exploration of the markets.